Hello and welcome back to the Legal Cheek podcast. My name is Julia Sanislow, and I am joined today once again by my fellow writer, Ryan Scott.
Hi, everybody.
Hello, hello. So, as interview season and assessment centres start ramping up, we thought that it would be a good idea to bring you all lots of different commercial themes that you can discuss during these sessions and think about over the coming year. We're going to be covering a lot of things today, but it is by no means an exhaustive list. We cannot cover everything. So don't feel limited to these five-ish loosely defined topics that we're going to talk about. We're going to talk about everything from geopolitical uncertainty and what this means for law firms and their clients, the rise of private capital and private credit, more specifically. Going to be talking about the US law firms' incursions into the London legal market and what this means for junior solicitors and senior solicitors alike, as well as talking briefly about legal tech and mergers. There's probably something that I've missed, but yes. Ryan, I was thinking I could hand over to you first. Geopolitical uncertainty is in itself quite an uncertain term, because people just drop it into a interview, perhaps saying this is going to affect law firms. But there are so many different ways that it can have an effect on both law firms and their clients. Do you mind talking us through it a little bit?
Yeah, well, you said there that this is by no means an exhaustive list of five things we want to talk about under the umbrella of geopolitical uncertainty. Well, we're living in one of the most geopolitical volatile periods in decades, I would say, or at least in my lifetime that I can think of. There's always something in the news you turn on that's kind of negative happening in the world. For law firms, there's kind of an upside to that in a kind of unfortunate way that there'll be a lot more work for them. When clients face uncertainty, it's likely that they'll need legal advice to be able to guide them through and navigate through this legal uncertainty. So I picked out a couple strands or topics within geopolitical volatility or uncertainty to discuss, but by no means are these exhaustive. You can read the news and see so many more. The first one I thought that might be relevant to applications and interviews was sanctions regimes. So I think starting off, what is a sanction? It's a legal restriction imposed by a government or kind of a super governmental body on dealing with another country or a person or a group of people. The sanctions might take the form of asset freezes, so freezing basically money, property, or shares, restrictions so you can't do any kind of exporting or importing of goods and services to and from certain countries, financial restrictions, so no lending, no investments, no banking involved in a specific country, and also services bans. So one that applies to law firms is that they might not be able to advise sanctioned countries. So what it potentially means for law firms is, as I say, you'd be potentially barred from advising on any deals involving that sanctioned country. But on the other side, there is actually an uptick in sanctions advisory work. So you've got to advise clients on how to comply with sanctions without breaking laws there, and that brings in a lot of work for big law firms. And you'll also have seen in the past couple of years, there's been quite a lot of international law firms that have retreated out of sanctioned countries like Russia, for example. I did a little bit of research for the podcast today, and there was a report in 2022 that basically talked about A&O Shearman, well, Alan Overy at the time, Clifford Chance, Freshfields, HSF before it's HSF Kramer, Hogan Lovells, Linklaters, and Baker McKenzie. They're just some of the few that pulled out of their Russian offices. Um, why might this be relevant to you in an interview or a case study? Well, if a case study mentions something like a dealing with a sanctioned country, so for example, you're looking at potential M&A, and one of the countries is based out of a country that you think is subject to sanctions, alarm bells should be ringing, thinking maybe we can't actually go ahead and buy this target company because it's subject to sanctions. Or perhaps you think that oh, well, we can go ahead and buy it, but we need some advice on sanctions. This is just how it affects law firms. I think the second thing I wanted to talk about was supply chain disruptions, which have been very prevalent in the last 5 years or so, I'd say. 6 years now, it's 2026. COVID started in 2020. So everything started with COVID. Factories shut down, workers were off sick, ports were closed, and then supply chain disruptions were exacerbated by Russia invading Ukraine. So both Ukraine and Russia were large suppliers of raw materials that we'd use to make goods. Ukraine supplied grain, so there was a big like food shortage and food insecurity issues there. And Russia supplied metals and energy. Energy prices spiked in Europe after the Russian invasion of Ukraine, which raised production costs for everybody and slowed everything down, trying to find new kind of means of getting energy. new sanctions regimes and trade restrictions have been imposed over the past couple of years. And then there's also been shipping bottlenecks, so shipping disruptions in the Red Sea because of Houthi attacks on ships. Um, Clients have responded to this by nearshoring or onshoring operations. So, say for example, um, Nike in the US is wanting to move its manufacturing processes from China to either the US or maybe Mexico, somewhere closer by. So they're going to be less kind of impacted by this supply chain disruption because it's a much closer country. One thing we have seen is Vietnam has become quite a popular destination for electronics, garments, consumer goods, and it's kind of this move away from China that we're seeing from a lot of companies. What legal work has this created? Well, there'll be a more comprehensive contract negotiation trying to draft contractual clauses that cover every eventuality and potentiality that we might not have been thinking of before. A lot of dispute resolution when contracts fall through or kind of supply contracts are delayed. So that's kind of an uptick of this supply chain disruption. And also advising companies on setting up new operations in different jurisdictions where they might not be impacted by these supply chain disruptions. And then one last thing I'd like to cover in this regard is economic uncertainty and bearish investors. So the volatility makes investors nervous. You don't want to put your money somewhere if you think that it might not be safe there or if it's not going to generate a return. They always say uncertainty kills deals. There's also been higher interest rates in the US and UK compared to like pre-COVID levels. So M&A and deal making has been a bit slower and financing is a lot more expensive. But then you think, well, what legal work has this created? There is kind of somewhat of a bright side to this. So we had distressed M&As, that's like buying companies when the valuations are cheap because they're struggling. Restructuring and insolvency work. So if a company takes out a big loan, it might have to get that loan restructured. So either delaying repayment or renegotiating payment terms with a bank or private credit lender, which we'll actually come on to. And insolvency work. So the company goes bankrupt or it goes into administration. Quite a lot of the big firms you'll be applying for do all this type of work, and have been an uptick in that. There's also something else, kind of a niche area within private equity called secondaries transactions. And I know Julia knows a little bit about this. If you just want to talk about what secondaries transactions are and kind of why they're booming at the moment.
Yeah, absolutely. So, broadly speaking, when private equity firms buy out businesses, the money is, as you'll mostly know, locked up for a certain number of years, and then at the end of the tends to be sort of 5 years. The idea is that you return all your money to your investors and you take a nice chunk of that as the fund manager. That's how they make money. However, in this sort of very economically uncertain period, there's been a bit of a problem with this traditional process because private equity funds haven't been able to essentially give their money back to their investors. They haven't been able to float. Float these companies. For instance, that's a traditional exit for a private equity funds, portfolio company. So when you put it on you list it on a stock exchange, that there's been a bit of a deal drought. So what do you do if you've got lots of these investors who are clawing for money, clawing for liquidity, because that's a lot of money that you've locked up for them. And what they've decided is what market's grown out of all of this is called the secondaries market, and that means traditionally you can give some money back, give some liquidity to your investors, and sell on your portfolio company to maybe another group of investors who are willing to still invest, or what's become even more common is called a continuation deal. And this has become a massive thing. If you just look in the FT a couple of days ago, big headline, private credit firms sell debt to themselves at record rate. And the reason they phrased it this way is because what private equity fund managers are doing is essentially selling this sort of fund that they've created with all of these portfolio companies back to themselves under a different fund, perhaps with different terms. And in that process, they say to their current investors, okay, you can buy out, you can essentially take your money and leave, and we're going to get some new people in, or you can stay and maybe get some better returns. Because the problem is they want to, A, keep these companies sort of on their with them for longer because maybe currently it's not a very good environment for getting the good returns that a private equity company is known for. yeah, so maybe they just want to keep it because there's potential there, or they're scared that it's just not going to be a good idea currently because they're not going to be able to get new investors for the next companies that they invest in. And so secondaries transactions are a huge area of growth for law firms. It's essentially a liquidity solution. And it also allows firms to sort of make extra money in management fees in that process. Sorry, that was a little bit of a roundabout explanation, but it's all about liquidity, i.e., cash in hand. In economically uncertain periods, people get antsy. They sort of get uncertain. They get nervous. And this is one way that law firms have been able to devise very novel and unique ways of sort of providing these services to private equity firms. And you can see, as we'll talk about later, lots of law firms are hiring based on these capabilities specifically and are centering their growth strategies on these areas. Sorry, back to you, Ryan, after that great
So,
segue.
no, it's all right. I think the key thing to take away from all of this with geopolitical uncertainty is that there is kind of an upside and downside. I think, as I say, for law firms, there is so much more work coming in when times are uncertain. Like it might just be a different type of work, like dispute resolution and litigation, arbitration will definitely be on the up when times are very uncertain. We don't know what's happening. There's been supply chain disruptions. Okay, it's delayed or it's not getting delivered at all. Let's go take it to arbitration. Let's go take it to court. But I think no matter kind of what the situation is, you can view it from like a positive or a negative. As I say, uptick in some work, downturn in kind of deal making, perhaps a rise in disputes. I think one last thing actually I do want to cover just very quickly is the Trump administration and trade policy. I mean, you could talk about this forever. Just quickly whizzing through it. Obviously, you've got tariffs. Everyone mentions tariffs. There's a baseline tariff on nearly all imported goods from other countries. I think it's 10%. And then you've got reciprocal tariffs. So there's placing higher duties on specific trading partners. I think it's like 25% with India at the moment, and that's on top of the baseline. And then there's additional tariffs on specific goods like oil or rare earth metals, things like that. Um, Another thing the Trump administration has done, amongst many things, is issue executive orders against several many US firms, preventing them from doing any kind of government-related legal work. So Perkins Coie is a good example of this. I think Perkins Coie represented Hillary Clinton during the kind of elections, and Trump wasn't very happy with this, issued an executive order against them and many other firms that he didn't agree with or was representing people he didn't like. That stopped them from doing lots of government contracts. There's also been a DEI pushback from the Trump administration. So firms have basically been getting in trouble if they have any sort of kind of hiring practices that have a DEI related focus, I guess you would say. And what the firms have had to do is strike deals with Trump. Quite a lot of them have pledged so many hours towards pro bono legal work. I can't remember any. I don't want to misspeak and say any firms that have struck deals, but there are quite a lot of US firms that have. So I don't want to say any if I'm uncertain, but there are a lot of firms that have pledged like hundreds of hours of thousands of hours of pro bono work. And then finally, the reneging of the Paris Agreement. The Paris Agreement is all about basically limiting the climate change against pre-industrial levels to 2 degrees above that, I believe. And Trump has reneged on that twice. First time when he was in office, and then the second time when he came into office, he took the US out of the Paris Agreement. I think it's epitomized in this phrase "drill, baby, drill." Like there's a bit of regressive thinking there, moving away from renewables and back to fossil fuels. Um, so all these things, like there's so much going on that I haven't spoken about here, but the point to gather is that there are upsides and downsides in terms of legal work. But with that, I think we'll move on to private credit. And Julie, I know you want to speak about that.
Yeah, thank you, Ryan. I think this focus on the US brings us quite nicely over to, well, private capital and private credit more specifically. So I think one of the things that people really need to bear in mind is how big the boom in any form of private capital has been over the last 20 years. This includes obviously like private equity, it includes private credit itself, which is lending. They're sort of like two, I think of them as cousins. And this has been driven in the most part by huge US based funds that, have very good relationships with US law firms. So that's an area we'll talk about in a moment. But essentially, what private credit is money that is lent by firms that aren't banks. And the reason it developed was that in the wake of the 2008 financial crisis, lots of banks became very heavily regulated in lots of different ways and were less keen, should we put it, or disincentivized from lending to riskier, in their view, companies. So this tended to be smaller ones. Um, but what this left was a huge gap in the market, where private credit swooped in and said, "Fine, we'll do all that lending," and it's a massive business now, and that means that it's providing lots and lots of work for law firms. Typically, you wanted to keep, close ties with your banking and finance, sort of investment people. But now, what's even more important is maintaining really, really good relationship with fund managers. And lots of these funds get their money from huge investors, like in private equity, pension funds, insurance, and sort of sovereign wealth funds. And they give long-term loans to companies over a long period of time, sometimes even longer than what a bank can do. And but the problem is that it's a less transparent industry, so it's come under a lot of scrutiny despite this massive growth. So it's got lots and lots of benefits that you can talk about. If you get like a case study, an investment related case study, you could talk about, where you would get the funding for this investment. Should you go into private credit, you'd get faster access to money potentially. Um, a lot of the times you can get very, very flexible repayment terms. But on the other hand, it can also be risky. And it's a very unregulated area, but it's incredibly profitable for law firms. We're going to talk about, I've just sort of talking myself into circles. We're going to talk about it a lot later. Um, but loads and loads of the hires that are going on in the UK legal market are in some way, shape, or form related to private funds or private equity. A lot of private equity deals rely on private capital, private credit as well. So it's sort of circular in a way. Um, and it's just it's an incredible area of growth that you know um fills that gap that banks won't fill, but now because of that it's coming under scrutiny, and I think it's worth around 3 trillion dollars in 2024, which has grown from, I can't remember what the number was, but it's expected to grow even further sort of to the end of the decade. So it's no longer a niche. It's certainly not as big as public lending, but it means that this scrutiny that's getting placed on it, it's sort of like signaling, yes, we consider you a serious area, and it's definitely worth talking about in your interviews as sort of an area not just of business for law firms, but as a potential capital pot for investors themselves. Yeah, that's a sort of high level overview. I didn't want to go too long.
I think what you mentioned there as well with the transparency of some of the deal documents, like banks are less willing to lend to risky lenders. I mean, it's partly willingness, I think, partly regulation. Like they have to have, I think, look at liquidity ratios of the
Yeah,
companies and stuff like that. Um, but I think one of the interesting things about private credit is that it hasn't really been fully stress tested yet. Like what will
no,
happen in a downturn. So if private credit if there is a recession and quite a lot of pension funds and savings funds actually invest money in private credit, so normal people and their pensions might get done over if some of these kind of untransparent loans or not properly looked into loans
yeah,
fail because the borrowers aren't credit worthy and it hasn't been looked into as much. And I don't think there's much publicly available information
yeah,
as to these investments compared to like bank lending. So it'd be interesting to see if there's like a big risk of default. I've seen some discussion of that in the news, but I guess
yeah.
only time will tell.
I think that the Bank of England launched a stress, sort of at the beginning of a stress test, I guess
Mhm.
you could call it, at the end of last year. But as you can see, that's really recent, given how, it's been around for like a decade and a half, and lots of people's, pensions are locked up into these private credit funds.
Yeah.
So it's very, very risky. The one other thing that's important to note is that it originally private credit started out as a way of just like direct, filling that gap for direct lending. So, just corporate, I guess, corporate finance. But a lot of more recently, it's also become it's gotten into asset-backed finance as well. So it's becoming more diversified as an area, and I think that would increase risk as well in a lot of ways because it's just becoming even bigger and even more of a replacement for traditional lending. Well, not a replacement, but sort of a competition, I suppose. Asset-backed finance are, loans that are secured on real assets. And a lot of these take the form of things like data centers. So the biggest private credit deal I think it happened fairly recently, was Meta and its massive data center in the US. That was a private credit operation, if you want to call it. And these huge infrastructure projects require a lot of money that banks aren't always willing to give out. So it's all very complicated. There's so much to talk about, but I think that sort of asset-backed finance is an important point to hit on, perhaps if you get I don't know, a data center case study in your interview.
Oh,
Start
that'll be
talking about it.
interesting. I'd like to see that.
I would get very confused if I had to talk about it on the spot, but it might be worth keeping in the back of your mind. But yeah, transparency is the issue here.
And then just moving on to, well, talking about US firms and kind of the private credit is a very big, I mean, it's very big over there. It's very big over here too. We want to move on to the third point. That's just American firms have been aggressively expanding into the London market in over the past decade or so, I'd say. I mean, I think they've been here for a very long time. Like some firms have been here since the 70s, the 80s, but it's only recently you've seen them really ramp up their kind of lateral hiring, but also introduce of partners, but also introducing training contracts or them making those training contract numbers much bigger. I think Paul Weiss, like in 2020, they had their kind of inaugural training contract and it was open to 5 people. And I think Wilkie also started in 2020 or 2021, but Paul Weiss now hires about 12 people, 12 trainees, if I'm correct, each year. So
Mhm.
they're really ramping up hiring and growing quite aggressively in London. I think just why are they expanding into London specifically? Well, London's the world's second biggest legal hub after New York. If you want to be a truly global firm, you've obviously got to have a presence in London. And clients also are increasingly globalized and they want a one-stop global shop for all of their needs. Um, and also, there's a lot of profitable work to be done in London. I mean, obviously, you got a lot of corporate work and deal making in America, and a lot of like big ticket work there, but we've also got a lot of international arbitration over here in the UK, a lot of finance and big ticket corporate work here as well, and lots of international contracts will be drafted so that English law applies. So it's good to have a presence in London, really, and I think that's why they're expanding over here. But there's a lot of consequences of this expansion, which may be good or bad depending on how you see it. I think first of all is salary inflation. Um, the elite US firms tend to pay a lot more money than UK firms do. So you compare the Magic Circle, which I believe are the highest paying UK founded firms for NQ rates, and it's 150K for an NQ at a Magic Circle firm, whereas Davis Polk or Polk, Davis Polk,
Yeah,
Davis Polk, Gibson Dunn, and Paul Weiss, I think they all pay 180K
yeah,
NQ. So there's a big 30 grand difference there. And also UK firms have been obviously pressured by this to raise their salaries to compete and not only retain talent, but actually to attract it in the first place. So Magic Circle in 2020 paid 100 grand. Magic Circle in 2022 or 2023 paid 125K. And then Magic Circle in 2024 and 2025 upped it to 150K. So it's gone from, in the space of 5 years, it's increased by almost half from 100K to 150K. So there's been this massive salary inflation that, I mean, I don't know if I can see it plateauing. Surely it's just got to keep, if the US firms keep on upping their salaries, surely the UK firms have got to match.
yeah.
But the US firms are much more profitable than UK firms, so this is just causing a bit of I guess, a strain on the UK firms. Because not only the Magic Circle that are obviously affected, Silver Circle firms, just any big city firm is having to up their wage too. Because if you see this difference between, all right, one firm's offering 180K and you're only offering like 100K, it's a blessed position to be in where you think, oh yes, 100K, that's a lot of money. But if there's an 80K difference, you can see like even the people with the most, I don't know, I guess solid mind, even if you love the firm to pieces, an 80K difference in wage might pull you over to the other side.
No,
But
absolutely.
Yeah, US firms are very profitable. There's a few reasons for that. First, to focus on ultra high margin work. I think you mentioned obviously private capital and credit earlier, but also big ticket M&A work, private equity, capital market stuff, and also they have the eat what you kill model. So partners will bring in work and they'll be incentivized to bring in that work because they'll get a big cut of the money of the work that they're bringing in. Whereas I think a traditional model for UK firms is the lockstep model. So partners get paid commensurately with their years of experience with a firm. So if they've been at a firm for 10 years, they're getting paid much more than a partner who's been there for 1 year. Whereas in the American firms, it's just how much work do you bring in? You'll be paid commensurately to that. Also, they have much smaller partnerships, so there's higher PEP figures in these US firms. Um, but yeah, I think we've reported on it a lot, and you know a bit about this, but also the lateral hiring boom with US firm expansion. Do you want to talk about that?
Yeah, absolutely. So if you look at just the numbers themselves, I think I was reading around before this podcast, but since 2020, around 80% of lateral partner hires have gone to top 50 US firms. So that is an overwhelming majority of top partners being poached into the likes of, Paul Weiss, Sidney Austin, Sullivan Cromwell, Kirkland and Ellis, all of these huge firms that, as you say, not only benefit from economies of scale, but also from this very big ticket work, which is based in areas which are hugely profitable. They're all very private capital based, and this isn't slowing down. I was looking just over the last couple of days to see, so I could, back my point. What kind of lateral hires have we seen over the last couple of weeks since the new year? And a lot of them have been based in private funds. There's Sullivan and Cromwell nicked two private funds partners from Weil, obviously also an American firm. Paul Weiss, this is in London, picked up a private equity partner also from Weil. Sidley Austin hired an entire funds team. I think that was in Europe, in Paris. Did you say that was?
Yeah, it was Paris,
Yeah,
I think it
Paris.
was.
So obviously that's European, but I think the key takeaway here is that US firms are very aware of the fact that Europe and London, obviously specifically, is an excellent market to build out in, but they're focusing intensely on these very private capital heavy areas, sorry. Um, and obviously, top UK firms are still hiring, there's still a lateral sort of hiring spree going on more generally. But I think because of these incentives, because perhaps there are smaller teams and you get higher PEP or PEP if you're a partner at these firms, because perhaps it's the firms have set up recently. So there's this allure of, oh, we're setting up something new. And like with Paul Weiss, they're really setting the pace on hiring at a senior level, but also on, as you say, pay for their juniors. Um, so there's just this like delightful mix of huge firms, huge big ticket client relationships and whatnot, and deal flows and whatnot. And then yeah, they're attracting all the juniors because pricing out all of the Magic Circle firms. That's madness.
You
Um,
mentioned something to me before that was really interesting about Weil, that they've brought back lots of their partners who have
yes,
left.
yes, they have, and a lot of them have been in capabilities which are very important for this sort of economic environment. Restructuring, which they're very, very good at. PE more broadly, private funds more broadly. They've also brought back people in their secondaries team. So yeah, I think in the first half of 2025 last year, there were 21 moves just in private equity, which is a lot for just the first half of a year for one practice area. So it's really, you know, even if there has been a bit of a slowdown in PE deals, things like the continuation funds that we talked about and the secondaries deals have allowed, private equity to still be one of the most profitable areas for firms based in London. Yeah, so but yeah, for a while, I suppose, on off topic, that bodes well for them because it means they clearly have something on offer. If they can attract back at
Yeah.
least 15 people, which is quite impressive. Yeah, so it's madness. And also, I think this brings us quite nicely into, we talked about this extensively in another podcast
Mm.
episode, but law firm mergers. all of them have been between US and UK firms. And I think a lot of it has to do with these financy, private capital capabilities and the huge scale and the huge profitability of lots of these sometimes smaller firms, sure, but they have that area of expertise that is just booming right now. I was wondering if you wanted to say something on that first.
Yeah, I think, as you say as well, it's usually always between a US and a UK based firm. I guess that's how we define that because Hogan Lovells is actually a US UK merger already, and then it's gone to Hogan Lovells Cadwallader, which is US UK dash US
US.
again,
Yeah.
US squared UK. But quite a lot of them are they're merging presumably because of kind of complementary practice area gaps. So. We did do a podcast on this a couple of weeks back. I think Cadwallader is like a very specialist finance firm based out of New York, and they only had four offices in like the US's kind of financial centers. I think it was New York, North Carolina. I remember we discussed that, and I thought I didn't realize North. I think it was North Carolina. Wasn't like
Charlotte.
a major fin. Yes, it was Charlotte. I didn't realize it was a major like financial hub in the US, but apparently it is. Um, yeah, so Cadwalader was quite small compared to Hogan Lovells, but it had this kind of specialist finance practice. Whereas then you look at Hogan Lovells and it's this big full service law firm that can offer all everything to its clients pretty much. But they're just kind of bulking out these other practice areas that have that maybe don't have that much kind of expertise in or they're not like top of the market in. So yeah, I think it's filling in practice area gaps and also access to each other's clients. Ashurst and Perkins Coie, for example, Ashurst is really big all over APAC and Europe, so Asia Pacific region, and Europe and the Middle East. Whereas Perkins Coie was pretty much primarily based out of the US and had like 20 offices in the US. So Perkins Coie can bring to the merger all of its clients from the US, and Ashurst can bring all of its clients from the rest of the world. And because the clients will be increasingly global, they can handle these multi-jurisdictional matters all in-house, and they've just got a much bigger kind of market share now. But yeah, I was wondering, I mean, do you want to touch more upon that, or do you want to talk about the challenges of mergers, perhaps?
I mean, main challenges that arise from mergers is usually, cultural differences.
Mm,
Um, it's just going to take a while for these very, very different models to assimilate to each other or for one to take over the other in some way,
yeah.
shape, or form. Training is usually quite different at a US firm. I think we spoke about that quite extensively. There's also the question as to whether it's an acquisition more than a merger.
Mm.
These very, these huge global firms like Hogan Lovells, and obviously Cadwallader is quite profitable, but is it more that Hogan Lovells is absorbing it into its way of doing things? What else is there?
And compensation issues too. So
Yeah,
like if you look at God, I always get this one wrong. Winston Taylor, I believe the merged firm is called, which is Winston and Strawn and Taylor Wessing. The PEP figures between the two firms, obviously before the merge, are very, very different. And that's just a legacy of, well, one's a US firm who deals with very kind of high value deal making and big ticket work, and has a much smaller partnership. And Taylor Wessing is much more full service and does all type of works for its clients, which might not be as high value. So when they come together, well, the partnership from Taylor Wessing and the partnership from Winston is drawn. How are they going to split the profits between the partners? You just don't know. And also, I think there's a big difference in trainee pay as well.
yeah, yeah, no,
Mm.
absolutely. I think running the risk of overrunning. What was our final topic? We were going to talk about legal tech very
Legal
briefly
tech.
again. We talked about it last week in detail, so go check out that episode if you haven't yet. Don't be a fake fan. Um, but it is still worth talking about both as an area of growth for law firms' client bases, but also just for law firms themselves and how they're implementing it. Ryan, do you want to give us a brief overview?
Yeah, so firms are investing lots of money into new legal tech and AI tools. Either they'll outsource to like external tech companies like Harvey or Legora, the big ones who just had million dollar valuations. They'll develop their own in-house tools, their own in-house legal tech tools. Oh, and they're also appointing things like AI officers. I think you said, was it Ashurst who had appointed an AI officer?
They definitely might have. I think I said Mills and Reevers when I spoke
That's
about
it.
one.
That is it. We spoke about it in the last. Go check out the last episode, and then you'll hear all about that. But also, a lot of firms are developing innovation teams that basically trying out these tools, how to improve them, and how to best streamline different kind of work processes that they've got in place. There's lots of different types of technology there. There's contract drafting, so AI will draft your contract for you, contract analysis, even legal research, AI assisted due diligence of doc review. So before trainees would sit and search through thousands of documents, now you can get kind of an AI platform that will filter for keywords and jurisdictions and things you're looking for. It makes it much, much easier, and also the admin side of it. So writing emails with Copilot, having an AI tool summarize meeting and like put into notes for you, and also time recording tools, which is a very, very like strenuous and boring task. But when AI does it for you, you don't really have to think about it anymore.
Yeah.
So it's just it's simplifying everything for you pretty much. But there's also kind of some impacts on the law firms. I know we spoke last week, Julie, about challenges to the billable hour, if you want to talk about that, and risk management with confidentiality and hallucinations.
Yeah, so for hallucinations, naturally, AI is not particularly reliable at the moment. It makes mistakes, and in an area as well, dangerous to mess up in as law, that can have a massive effect both in litigation with fake cases being cited that have been made up or hallucinated by AI, or with mistakes in contracts, things like that. There's that huge database that we mentioned last week where some legal researcher, I think he's Paris-based, has essentially collated a list of all of the times that cases have been cited that are completely wrong in courts. And it's really funny because there are so many every single week, and it's not very consistent, and this is a major stressor for lots of different law firms because it means that it requires a person to go and sense check everything, and you really don't want to become liable. Who's gonna pay if you send someone falsely to prison or something? For an extreme example, but it could happen. I hope that there are safeguards in place, but and also in terms of the way that law firms are interacting with their clients on this matter, if you have a tool that is able to speed things up to the level that AI can, for example, with contract review, it's only natural to assume that clients who want to, you know, pay as little as possible for the services that they're getting from you will say, don't waste time, use AI and do this as quickly as possible so that I can pay you less. And also, if there are services now that law firms can predict more easily how long something is going to take, or they can put systems in place which are easily quantifiable. Maybe they'll be able to provide more fixed fee, um, cost arrangements that would make the billable hour slightly less common in certain circumstances. And it's certainly a thing that clients are thinking about. And so it's becoming more an area of conversation. I think I said last week that the billable hour is not disappearing anytime soon because legal work is by its very nature extremely unpredictable. And you can't know, for instance, what's going to happen during the course of a deal. If something happens and affects the entire timeline, then you have no choice, no matter how well you can predict how long a contract is going to take to draft. If something goes wrong, something goes wrong. Or in litigation, even more the case, like that's just unpredictable. Um, but it is definitely an area that clients are thinking about and law firms are being forced to think about because client relationships, managing those, that's the most important thing for a lot of the law firms. And in an increasingly competitive space, you need to be able to provide not only the best service, but the best structure for that service and the best client care. So it all forms a part of that.
It's also worth knowing as well about how it's going to impact you. So as like a junior lawyer going into the firm, because you might get asked about it. Your job will probably be a lot more reliant on legal tech. I remember Freshfields announced back in maybe September last year sometime that they're now offering a legal tech and like AI course at KCL as part of its training contract program to some of its future trainees, which sounded really interesting. But you'll need to be familiar with how to use kind of like AI and legal tech going into your job. I imagine it'll become much more prevalent. And you'll spend a lot less time doing the drudge work. So we said last week, like doc review and research might be a lot quicker now. And your role will essentially turn to that of what an associate used to be, where you're now reviewing the output of what the AI has written for you and just checking that for accuracy, making sure it's okay to go to the client. Whereas before, you'd obviously do that first draft and then send it to the associate to review. And because you're saving time on these more rote or kind of like labor intensive repetitive tasks, potentially with more time for you to kind of add value to a deal, or like I don't know, you will do some more critical analysis of something that the AI cannot think of, or you might have some more time with client interaction. Who knows? We'll just have to see how it changes. But I think with that we covered what, five or so, I think that's how we're going to put it, five or so commercial awareness topics, as we've spoken about quite a lot. But there is so much you should be, you cannot be expected to know everything going into a training contract interview. So what I'd say is just make sure to keep checking in on the news. Read news stories that obviously we haven't covered. There might be something in the papers that interests you, that might be relevant to something you're discussing. So, for example, for me, I know I talked about renewables and battery storage in my interview because that was something that interested me. And I knew the partner also was working in energy and renewables. So I thought this might be relevant to him as well and to the discussion. But yeah, commercial awareness is a really important skill for a lawyer to have. It's kind of hard. It's kind of an airy concept. It's hard to describe what it actually means and what you need to know. I wish there was just a checklist of you need to know this, that, and the other.
Yeah.
But lawyers need to not they need to be able to apply the law, but not in a vacuum. They need to be able to understand their clients' intentions and what's actually going on in the world. And reading the news is a very big of that, I'd say. Um, but yeah, is there anything you want to cover off, Julia, before we wrap this up?
Yeah, I think you said everything really. The one thing I would flag is that I think it's talking about commercial awareness, it's a bit scary, and I encourage everyone to not view it that way and to think about it as something that's interesting and being aware of what's going on in the world around you, in the around the profession that you want to enter should excite you. You can't know everything, and that's fine. But what I would also stress is that commercial awareness is a little bit disingenuous because what you really need to know what you really need to do is be aware of what's going on around you and what's going on around your potential clients, and then be able to talk about it. So I think it's more apt to talk almost about commercial fluency. So what I would do is just talk to people that you know in your life, discuss things randomly, bother your parents if you live at home with them. It's like, Mum, did you hear about this cool thing? Can I talk to you about it? And become comfortable, um, in that vocabulary, because I think that's the thing that freaks people out the most. A lot of it is very opaque. The FT is very technical, for instance. It's going to be a bit confusing. So get comfortable talking about it. Get commercially fluent rather than just commercially aware.
And look, we're still learning as well. We did so much preparation before this podcast. Like, we can't know everything. Like, we had to read the papers as well to check up on the kind of things we were saying. There's always something to learn. There's always something going on in the news. So the more regularly you keep up with it, and the earlier you actually start with your commercial awareness training or research, I guess, the quicker it's going to come to you, and the quicker it's all going to start making sense soon, and you'll be able to kind of contextualize deals or disputes in the sense of understanding what else is going on in the world. How does this apply to my client? And that will really help you, I find. And I think most firms do a case study and they don't assess you necessarily on like legal knowledge because quite a lot of people come from non-law backgrounds. Like Julie, I know you're from a languages background. Um, I did a lot at uni, but I found that the case studies I did do were not, they were, it was obviously a legal case study, but there's a lot of commercial considerations to think about. And you didn't have to come in there knowing about like contractual terms or how an M&A works from like the legal document side and stuff like that. It's good to know, but like if you didn't, just think about what you read in the news and how that applies here. But I think that's all I've got to say on these five commercial awareness topics. I hope everyone has a fantastic application season, and I hope listening to this has helped and maybe ease some of your concerns around what this concept of commercial awareness means and maybe what you should know going into an interview.
Yeah. Thank you everyone for listening, and we shall see you next week. Bye bye.
Bye, everyone.